Imagine raising $75 billion in cash in like a single afternoon.
Yeah, it's completely wild.
And at the exact same time, minting the world's first individual trillionaire. Oh, and also revealing a secret financial roadmap to colonize Mars, all in the same document.
I mean, it sounds exactly like the plot of a science fiction novel.
It really does.
But, that is exactly what unfolded in the global financial markets this past week.
Welcome to the Deep Dive, everyone. I'm your host, and I am so thrilled you're joining us today.
And I'm your resident financial expert, and I am really excited to dig into this one.
Because, well, we're unpacking an event today that has completely rewritten the rules of modern capitalism.
Absolutely.
For more than 2 decades, SpaceX has been this ultimate black box. We could all look up at the sky and see their rockets landing backward on drone ships.
Right, the viral videos.
Exactly. And we could see those Starlink satellites trailing across the stars.
Wow.
But the actual business side, the balance sheet, the profit, the massive losses, it was all hidden behind the locked doors of a private company.
Well, that is, until they filed an S-1.
Right.
And for those who might not be familiar with the term, an S-1 is the registration document a company has to file with the SEC, the Securities and Exchange Commission, before going public.
It's basically a mandatory financial autopsy.
That's a great way to put it. You really cannot hide anymore once you file that. You have to lay bare every single risk, every debt, every ambitious project, and every related party transaction for the entire world to see.
And man, what a document it is. Our mission today is to take this mountain of complex, incredibly dense financial data, which is a highly secretive filing that has Wall Street analysts completely divided, by the way, and just break it down into plain English.
Yeah, we're skipping all the confusing jargon and the dense Wall Street speak today.
Right. We want to guide you through the thrilling and at times genuinely mind-bending reality of a $1.77 trillion space, an artificial intelligence behemoth that just became a publicly traded stock.
And it is an imposing stack of paperwork. I mean, the document alone is hundreds of pages long.
I can't even imagine reading the whole thing.
It's filled with footnotes that contradict the headline numbers and accounting structures that look way more like corporate origami than traditional finance.
Corporate origami! I love that!
But, if you know where to look, it tells the most fascinating business story of the century.
Which is exactly why we rely on you. Listeners, our expert is here to help us navigate this whole maze. What we need today is your ability to look right past that day one media hype, cut through all the retail noise, and, connect the dots on what the underlying mechanics of this business actually look like.
I'm ready for it. It's incredibly easy to get blinded by the spectacle of orbital launches and, trillion-dollar price tags.
Oh, for sure.
But the real truth of how this company is surviving and where it's bleeding cash is buried super deep in the accounting methodologies.
Yeah.
So that's where we're going to find our answers.
So before we even look at what SpaceX actually does or how they make their money, we need to talk about how they went public. Because the mechanics of this initial public offering were entirely unprecedented. They didn't just break the traditional rules of Wall Street, they seemingly engineered an event designed to create absolute market hysteria.
They really did.
Let's start with the sheer scale of the offering, because the raw numbers are, well, they're difficult to even process.
The scale is historic. In this offering, SpaceX sold 555.5 million shares to the public.
Okay.
And by selling those shares, the company pulled in $75 billion in pure cash.
$75 billion in a single corporate event.
Yes. And to truly wrap your head around how massive that is, we have to look at the previous world record for an IPO.
Which was who?
That record belonged to Saudi Aramco, the state-owned oil giant of Saudi Arabia.
Oh, right.
Back in 2019, they raised $29.4 billion. And at the time, analysts thought that record would stand for decades.
Wow.
Yeah, SpaceX just came along and lapped the largest, most profitable oil company on Earth 2.5 times over.
That is insane.
Based on that $75 billion capital raise, the initial valuation of the company was pegged at somewhere between $1.75 and $1.7 trillion.
Which instantly makes it one of the most valuable entities ever created. But there is a glaring anomaly in how they achieved this, right? Something that goes against, decades of investment banking tradition.
Oh, absolutely.
Because when a normal mega cap company decides to go public, they engage in a process called book building.
Right.
The underwriters, the big banks like Goldman Sachs or Morgan Stanley, they go on a roadshow, they meet with massive institutional investors, pension funds, sovereign wealth funds, and they offer a price range.
Yeah, they basically say, we're thinking of pricing this between $45 and $50 a share. Yeah. What are you actually willing to pay?
Exactly. The banks use that range to gauge real-world demand. It's a price discovery mechanism, right?
Yes. If the institutions balk, the price goes down.
Right.
If they're desperate for shares, the price goes right to the top of the range.
Right. But the sources show SpaceX completely bypassed that entire mechanism. They didn't offer a range. They didn't even ask Wall Street what they thought the company was worth.
Not at all.
They just slapped a fixed $135 price tag on the shares right out of the gate. I mean, it reminds me of someone trying to sell a sprawling multi-million-dollar mansion in a super exclusive neighborhood.
Okay, I like this analogy.
Instead of taking bids or holding an open house to let the market decide the value, the owner just hammers a wooden sign into the front lawn with a non-negotiable price, locks the front door, and says, take it or leave it.
It is the ultimate flex of corporate confidence.
It really is a massive flex, and it signals a fundamental power shift, doesn't it?
It does. For the last 50 years, Wall Street banks held the power in the IPO process. They acted as the ultimate gatekeepers.
Right.
SpaceX essentially told those gatekeepers that they just weren't needed for price discovery. The brand is so strong and the retail anticipation is so incredibly high that the company dictated its own terms to the market.
And what's truly astonishing is that the market completely submitted to those terms.
They bowed down completely.
Let's talk about what actually happened on June 12, 2026. The day the stock officially began trading on the NASDAQ under the ticker symbol SPCX.
Oh man, what a day.
We knew there was going to be excitement, but the reality kind of broke the system, didn't it?
It literally broke the matching engines.
Wow.
On a typical IPO morning, the exchange uses a software system to match buy orders with sell orders to find a clean opening price.
Makes sense.
But the demand for SPCX was so overwhelming. I mean, millions upon millions of market buy orders flooding in at the exact same millisecond that the NASDAQ had to delay the opening bell for the stock for nearly half an hour.
Just to sort it out.
Yeah, just to manually build the matching pool.
That's wild. And when the stock finally unfroze and started trading, it didn't open at that fixed $135 price tag, did it?
Not even close. The imbalance between buyers and sellers was so extreme that the stock gapped up to $150 before a single share even traded hands in the secondary market.
Incredible.
From there, the momentum was just violent. It hit an intraday high of $176.52 before finally settling down slightly to close its first day at $160.95.
So it jumped 19% on its very first day of existence as a public company.
Yes, and that 19% jump had immediate historic consequences.
Like what?
Well, it pushed the company's total valuation to $2.1 trillion.
Just casually crossing the $2 trillion mark.
Exactly. In a matter of hours, SpaceX became the sixth largest publicly traded company in the United States. And as a direct side effect of that valuation, it officially crowned Elon Musk as the world's first individual trillionaire.
Which is a milestone that financial historians will be writing about for a century.
Oh, absolutely.
But I want to pause here and look at the actual physics of that day one price explosion, because according to the financial analysts in our sources, that 19% pop wasn't just organic, naturally occurring enthusiasm.
Right.
It was a structural supply squeeze that was deliberately, meticulously engineered by the company itself.
You're hitting on the core of why this IPO traded the way it did. To understand the volatility, we have to look at how they engineered the retail float.
Explain that for us.
In a standard mega-cap IPO, the vast majority of the shares, sometimes up to 90%, are allocated to institutional investors.
The big guys.
Right. The everyday retail investors, the people trading on their phones through brokerage apps, they might get a tiny 10% slice of the pie.
Okay.
But SpaceX completely flipped that script. They allocated an unprecedented 30% of the public float directly to everyday retail investors.
So they gave the general public 3 times the normal amount of access.
Exactly.
And on top of that, they executed a stock split right before the IPO to make those shares look cheaper, right?
They did. In May of 2026, just weeks before going public, they executed a 5-for-1 stock split.
What does that actually do?
Well, it divides every existing share into 5, cutting the nominal price of each share by 80% without changing the overall value of the company.
So it's purely psychological.
Purely psychological and structural. A lower individual share price lowers the barrier to entry. It's much easier for, say, a college student or a retail day trader to justify buying a handful of shares at $135 than buying a single share at $675.
That makes total sense. So they intentionally lowered the entry price and they heavily promoted this massive 30% allocation to the retail market.
Yes.
But here is the massive catch that the sources point out. Even though they sold 555 million shares to the public, the total free float, which is the actual percentage of the company's total shares that are available to be bought and sold on the open market, was incredibly tiny.
It was hovering around just 4%.
4%.
Let that sink in. 96% of the entire company was still locked up by insiders, early venture capitalists, and Elon Musk himself. Those shares could not be traded.
So play devil's advocate for me here for a second. If the company intentionally chops up the shares to artificially lower the nominal price, heavily cords a retail audience known for meme stock frenzy, but simultaneously chokes off the actual supply of shares available to a microscopic 4%. Aren't they just engineering a hype bubble?
That is a very fair question.
Does a $160 closing price actually tell us anything about the fundamental intrinsic value of the aerospace company? Or is it just the mechanical result of a design supply squeeze?
It is absolutely a manufactured squeeze, and any serious investor knows this. The closing price on day one heavily reflects the physics of market structure, not the physics of rocket science.
Right.
Think of it like a concert venue. If you have 50,000 screaming fans trying to get into a venue that only has 2,000 seats, the price of a ticket on the resale market is going to skyrocket to an absurd number.
Because everyone wants in.
Exactly. But that ticket price doesn't mean the band is inherently making better music, right?
Yeah.
It just means demand has completely overwhelmed a highly restricted supply.
That makes perfect sense. So when we see a $2.1 trillion market cap flashing in green on the financial news networks, we have to be incredibly careful.
Extremely careful.
We cannot assume the market has efficiently priced the company based on its actual cash flow.
Exactly. The day one valuation is a mirage built on scarcity. The true test comes in the months ahead.
When the lockups expire.
Yes. Eventually, those lockup periods will expire. That means the insiders holding that other 96% of the company will be legally allowed to sell their shares on the open market.
And what happens then?
When that massive flood of new supply hits the exchanges, the artificial scarcity vanishes. At that point, the only thing that will support the stock price is the actual fundamental health of the underlying business.
Which means we need to look under the hood.
We do.
Because if the stock price is temporarily detached from reality, we have to find out what reality actually looks like. And that leads us to the S1 autopsy.
The fun part.
When SpaceX finally opened its books, the headline numbers presented a massive, almost irreconcilable contradiction.
It's the kind of contradiction that keeps accountants awake at night.
Seriously. Let's look at the raw data for the full fiscal year of 2025. On the top line, the revenue picture is spectacular. SpaceX generated $18.67 billion in revenue.
Which is huge.
That is a 33% year-over-year growth rate. For an industrial manufacturing and aerospace company of this size to grow its top line by 33% is staggering. That is a massive amount of cash coming through the door.
It's the kind of growth you usually expect from a nimble software startup, not a company building 1,000-ton steel rockets.
Yeah, but then you drag your finger down the spreadsheet to the bottom line and the story completely fractures.
It really does.
Despite bringing in nearly $19 billion, SpaceX posted a catastrophic net loss of $4.94 billion for the year.
Almost $5 billion lost.
And the bleeding didn't stop there. In just the first quarter of 2026, they lost an additional $4.28 billion.
To put that in perspective, they lost almost as much money in 3 months of 2026 as they did in the entire 12 months of 2025.
Wow.
The cash burn is accelerating at a terrifying rate.
So, how does a company make $19 billion and still lose $5 billion? What are they doing with all that money?
To answer that, we have to translate some highly complex, somewhat controversial accounting rules into simple terms.
Okay, lead the way.
Specifically, we need to talk about a practice known as common control accounting.
Let's really dig into this because this concept completely changes the entire narrative of what you, the listener, probably thinks SpaceX actually is.
It's a huge curveball.
The numbers in this S1 filing, the $19 billion in revenue and the $5 billion in losses, they don't just represent the rocket company, do they?
No, they don't. And this is the great illusion of the S1.
Okay.
In February of 2026, just a few short months before this IPO was finalized, Elon Musk executed one of the most audacious corporate restructurings in modern business history.
What did he do?
He took his artificial intelligence company, xAI, and merged it directly into SpaceX.
But xAI wasn't just an AI research lab anymore, because the year prior, in 2025, xAI had already acquired X, the global social media platform formerly known as Twitter.
Exactly. So Musk took a social media network, folded it into an artificial intelligence startup, and then took that entire combined entity and jammed it inside an aerospace and satellite internet company.
It is literally a corporate Russian nesting doll.
It is. But here is where the accounting magic comes into play. Because Elon Musk personally held the majority voting control over all three of these legally separate entities before the merger, the regulatory agencies allow the accountants to use common control accounting.
And what does that allow them to do?
This rule allows the company to retroactively rewrite their financial history for the regulators. They're legally allowed to present the financial results for 2023, 2024, and 2025 as if SpaceX, xAI, and X had always been one single giant consolidated company.
Wait, really?
Yes.
Okay, let me try to ground this with a real-world analogy to make sure I'm fully grasping the absurdity of this.
Go for it.
Let's imagine 3 roommates who suddenly decide they want to merge all their personal bank accounts overnight because they are trying to qualify for a massive multi-million-dollar mortgage.
I like where this is going.
Roommate A is a highly successful engineer. They make a massive salary, they are incredibly profitable, and they pay all the bills. That's the Starlink satellite business.
Spot on.
Roommate B is brilliant, but currently unemployed, bleeding thousands of dollars a month to build a massive, power-hungry supercomputer in the garage. That's xAI.
Also correct.
And roommate C is a volatile media personality carrying a mountain of high-interest credit card debt from a social media addiction. That's Twitter.
It's a highly dysfunctional household.
Very. But when they walk into the bank to apply for this mortgage, they don't show the loan officer 3 separate chaotic financial lives.
No, they don't.
Thanks to this accounting rule, they hand over one beautifully merged spreadsheet. This single piece of paper pools roommate A's massive income with roommate B and C's massive debts into one giant ambiguous pot. And the paperwork acts like they've been legally married for the last 3 years.
That is a phenomenal way to explain it. You, the investor buying this stock, are the loan officer at that bank.
Right.
There is no clean, isolated before and after picture of just the rocket company. You are being handed the merged spreadsheet of the 3 roommates.
Wow.
So when you see that 2025 revenue number of $18.67 billion, you're seeing the launch contracts for the rockets, the monthly subscription fees for satellite internet, and the advertising revenue from the Twitter timeline all mixed together in a blender.
And when you see the $4.94 billion net loss.
You're seeing the massive engineering costs of building stainless steel rockets in Texas, combined with the multi-billion-dollar cash burn of buying graphic processing units to train AI models, combined with the debt servicing costs of a social media acquisition.
It is an amalgamation of 3 entirely different industries.
Exactly. It completely redefines what the ticker symbol SPCX actually represents.
Right. The S1 forces us to look at a newly revealed corporate structure. It's no longer just an aerospace company. The sources indicate it is officially structured as a 3-engine conglomerate.
Yes, the filing explicitly divides the business into 3 distinct reporting segments. First, you have the space segment. This is the legacy business.
The rockets.
Right. It encompasses the Falcon 9 rockets, the Dragon capsules that take astronauts to the International Space Station, and the development of the new massive Starship vehicle.
Okay, what's next?
Second, you have the connectivity segment. This is almost entirely Starlink, their global satellite internet constellation.
Got it.
And third, you have the AI segment. This is the new wild frontier, bringing together the Grok large language model, the X social media platform, and the physical construction of massive AI data centers on Earth.
So as an investor buying shares today, you aren't just buying a ticket to Mars.
Not at all. You're buying a global telecommunications provider, an aerospace defense contractor, and a frontier artificial intelligence lab, all wrapped up into a single stock.
And that leads to a fascinating and deeply polarizing financial dynamic.
How so?
Because when you break apart that merged roommate spreadsheet to see who is actually generating the cash to keep the lights on, the picture becomes incredibly stark.
We really have to find out what is funding this multi-billion-dollar burn rate. If the overall consolidated company is bleeding $5 billion a year, one of these segments has to be generating real, hard cash to prevent the whole thing from collapsing.
Exactly.
And the answer, shockingly to many people who only focus on the rocket launches, isn't the space segment, It's the satellites.
This was undeniably the most illuminating revelation in the entire 370-page document. The connectivity segment, Starlink, is the golden goose.
The golden goose.
It is the only truly wildly profitable part of the entire conglomerate.
Let's break down those Starlink numbers because they are staggering.
In 2025, the Starlink segment alone generated $11.4 billion in revenue. Wow.
That means that out of the company's total $18.6 billion in revenue, Starlink accounted for roughly 61% of it.
More than half.
Yeah. But top-line revenue isn't the important part here. While the rocket segment and the AI segment were incinerating cash at record speeds, Starlink generated $4.4 billion in pure operating profit.
It is an absolute profit engine. And the subscriber growth driving that profit is explosive.
It really is.
According to the S1, Starlink grew its user base to 10.3 million active subscribers by the first quarter of 2026. They literally doubled their global subscriber base in a single year, up from just 5 million the year prior.
It's an adoption curve that legacy telecom companies can only dream of.
I bet.
But if you read the fine print and the user metrics, there is a very interesting, almost counterintuitive nuance buried in that subscriber math.
What's that?
While the total number of users doubled, the average revenue per user, a vital metric the telecom industry refers to as ARPU, actually dropped significantly.
It dropped.
Yes, it fell from $99 a month down to $66 a month globally.
Okay, I want to view this from the perspective of a traditional Wall Street analyst, and, well, my alarm bells are ringing loudly.
Understandably.
In any normal publicly traded subscription business, whether it's Netflix, Verizon, or AT&T, if your average customer is suddenly paying you 33% less than they used to, your investors would hit the panic button.
Oh, absolutely.
A 33% drop in ARPU looks like a massive pricing collapse. It looks like you are losing your pricing power and engaging in a desperate race to the bottom just to artificially inflate your user numbers before an IPO. So why is the company framing this massive drop in average revenue as a strategic victory?
It is a brilliant observation, and it requires us to completely rethink how telecommunications infrastructure actually works.
Okay, rethink it how?
The traditional rules of Verizon or AT&T do not apply here because of an economic principle called zero marginal cost.
Zero marginal cost.
Yes. You have to visualize the physical infrastructure of Starlink. SpaceX has already spent the billions of dollars required to design the satellites. They've already paid for the rocket fuel to launch them.
Right.
That constellation of thousands of routers is already up there in low Earth orbit, spinning around the globe at 17,000 miles per hour.
So the multi-billion-dollar capital expenditure is already in the past. It's a sunk cost.
Precisely. The network exists whether a customer logs on or not.
Ah, I see.
So let's say a satellite is orbiting over the United States. It's beaming internet to customers paying $120 a month. But 45 minutes later, that exact same satellite is orbiting over a rural village in South America or a remote community in Africa.
Where $120 a month is impossible.
Exactly. In those markets, $120 a month is completely unaffordable. If SpaceX maintains that high price, the satellite passes overhead and beams signal to nobody. It generates zero revenue for that portion of its orbit.
I see. So instead of making $0, they adjust the pricing to fit the local economy.
Exactly. They might drop the price to $30 or even $20 a month in certain emerging markets. Now, the average revenue per user mathematically drops.
But they're making some money instead of no money.
Exactly. And here is the genius of it. Because the satellite is already passing overhead and the ground stations are already operational, adding that new customer in a rural village costs SpaceX virtually nothing in incremental expenses.
Zero marginal cost.
Right. It is pure high-margin revenue dropping straight to the bottom line. They are intentionally and aggressively trading high individual subscription prices for massive, unprecedented global volume. They want to connect the entire unconnected world.
So a drop in the average price doesn't mean their core American or European customers are demanding discounts.
Not at all.
It just means the demographic mix of the global user base is expanding into lower income regions, which is exactly what a global constellation is designed to do.
Yes. And we also cannot ignore the other extreme end of their customer base, which provides a massive counterbalance.
Who's on the other end?
The S1 spends a lot of time detailing their push into enterprise and commercial clients. We aren't just talking about a dish on a residential roof. Starlink is locking down massive fleet-wide contracts with major airlines, international cruise ship operators, and global maritime shipping fleets.
And those clients certainly aren't paying $66 a month.
Not at all. They are paying thousands, sometimes tens of thousands of dollars a month for high bandwidth, low latency, mission-critical connectivity.
Wow.
And this provides incredibly sticky, high-margin revenue with essentially zero churn.
Zero churn, like nobody leaves.
Basically, the filing literally notes a statistic that should terrify legacy satellite providers. Since 2023, not a single Starlink enterprise customer paying more than $750,000 a year has voluntarily canceled their service.
I mean, because what is the alternative? If you are managing a fleet of oil tankers in the middle of the Pacific Ocean, there's literally no competitor you can switch to that offers the same bandwidth and latency.
Exactly.
Starlink has effectively built a monopoly over the world's oceans.
They have. The connectivity segment is a phenomenal, highly profitable, structurally dominant business that is scaling at a breathtaking pace. It is the engine keeping the entire conglomerate alive.
But that brings us back to the most massive contradiction of the entire document.
Losses.
Right. If Starlink is generating $4.4 billion in operating profit and locking down zero-churn enterprise contracts, why on earth is the overall consolidated company losing nearly $5 billion a year?
That's a great question.
Where is all that golden goose money actually going?
It is being funneled directly into two massive, highly speculative, capital-intensive black holes: the Starship rocket program and the newly acquired artificial intelligence segment.
Let's start with the rockets. This is the space segment, the part of the company that everyone is most familiar with, right? The Falcon 9 rockets landing on barges, the Dragon capsules ferrying supplies and astronauts.
Yes, the core legacy business.
According to the S1, the space segment generated $4.1 billion in revenue in 2025. That sounds great. But it actually lost $657 million. Why is the most successful commercial launch provider in human history operating its rocket division as a loss leader?
Because of one word: Starship.
Starship.
Yes. The filing pulls back the curtain on the true cost of innovation. It reveals that SpaceX poured roughly $3 billion into pure research, development, and explosive testing for the Starship program in 2025 alone.
$3 billion in a single year just on R&D.
Just on R&D.
For those who aren't avid space followers, Starship is the massive, fully reusable, next-generation rocket they are building and testing down in Boca Chica, Texas. It's the largest flying object ever constructed.
And it is the absolute non-negotiable linchpin for everything the conglomerate wants to achieve over the next decade.
Why is it so important?
They explicitly state in the risk factors section of the S1 that if Starship fails or is significantly delayed, the entire growth thesis of the company is severely compromised.
But why is it so critical? They already have the Falcon 9, which launches almost every few days. Why bet the entire company on an unproven, vastly more expensive architecture?
Because they have maxed out the physical capabilities of the Falcon 9.
Ah, okay.
The next generation of Starlink satellites, the V3 satellites, are the key to lowering that marginal cost even further and increasing global bandwidth.
Right.
But the V3 satellites are physically massive. They literally cannot fit inside the payload fairing of a Falcon 9 rocket. Furthermore, they are incredibly heavy.
So they just need a bigger boat, essentially.
Exactly. To launch them in numbers that make economic sense, SpaceX needs the unprecedented massive cargo capacity of Starship.
So without Starship, the Starlink constellation eventually hits a technological ceiling.
Yes, but it goes further than that. As we will discuss shortly, they also need Starship's massive lift capacity to launch the physical infrastructure for their orbital AI data centers.
Oh, right.
And ultimately, Starship is the only vehicle in the pipeline capable of fulfilling Elon Musk's foundational, stated goal of transporting humans and cargo to colonize Mars.
So Starship isn't just a side project or a vanity pursuit. If the engineering fails, or if the Federal Aviation Administration ties them up in years of regulatory red tape, the $1.77 trillion valuation thesis hits a brick wall.
Absolutely.
The $3 billion they burned on it last year is a massive existential bet that they can get it fully operational, rapidly reusable, and cleared for daily flight.
That is exactly right.
Okay, so that explains the $657 million loss in the legacy space segment. But honestly, losing $500 million on rockets feels like a rounding error compared to the most shocking financial revelation in the entire document.
Oh, you mean the AI black hole?
Yes, we need to talk about the AI segment. This is the newly merged entity combining xAI's research and Twitter's data. The S1 shows that in 2025, the AI segment posted a staggering, mind-numbing $6.4 billion operating loss.
And it is accelerating.
Accelerating.
The filing shows another $2.5 billion loss in just the first quarter of 2026. The capital expenditure occurring inside this segment is almost difficult to comprehend.
How bad is it?
The AI division accounted for 61% of the entire company's capital spending in 2025. By early 2026, it was consuming 76% of all capital expenditures.
What exactly are they buying with all that cash?
They are buying compute, raw, physical infrastructure. They are building gigawatt-scale AI training clusters on Earth.
Like data centers?
Yes. The filing details facilities they have named Colossus and Colossus Timance. These are not your average server rooms. These are massive, sprawling industrial warehouses packed with hundreds of thousands of highly expensive, highly sought-after NVIDIA graphics processing units.
And running hundreds of thousands of GPUs requires a shocking amount of resources.
It does. It requires vast amounts of electricity, putting massive strain on local power grids, and it requires enormous amounts of water and specialized infrastructure just to cool the servers down so they don't melt.
Wow.
All of this physical infrastructure is being built at breakneck speed to train their proprietary large language model, Grok, and to process the real-time global data fire hose pouring in from the X social media platform.
But the S1 didn't just reveal the massive costs. It also revealed a few hidden gems inside that AI black hole, right? Strategic partnerships and contracts that Wall Street was not entirely expecting.
Right. There's some huge reveals here.
These are deals that fundamentally shift how we view SpaceX's role in the broader technology ecosystem.
Yes, there are two massive disclosures here that prove SpaceX isn't just trying to build a chatbot. They are trying to become the foundational layer of the entire AI economy.
What's the first one?
The first is a massive compute provision deal with Anthropic, which is widely considered one of the top 3 frontier AI research labs in the world.
And the numbers on this deal are just wild. According to the filing, SpaceX's Colossus data center division signed a contract to lease out raw compute power to Anthropic.
Yes.
And Anthropic has agreed to pay SpaceX $1.25 billion per month through May of 2029.
Think about the magnitude of that. That equates to roughly $45 billion in guaranteed revenue over the life of the contract.
$45 billion.
It is one of the largest disclosed artificial intelligence infrastructure commitments in corporate history. It completely repositions SpaceX in the market.
So?
They are no longer just an AI developer competing with OpenAI or Google. They are acting as a primary infrastructure provider, what the industry calls a hyperscaler. They are selling the picks and shovels to the other gold miners in the AI rush.
But as an investor reading the fine print, there is a significant catch to that $45 billion headline number, isn't there?
Yes, there is a massive caveat the traders need to be aware of.
Let's hear it.
The contract includes a 90-day mutual termination clause.
Meaning they can just walk away.
Exactly. This means that either Anthropic or SpaceX can legally exit the deal at any time for any reason with just 3 months of advance notice.
Wow.
So while $45 billion is an incredible headline, it is not a locked-in, guaranteed revenue stream for the next 3 years. It is essentially a massive, highly revocable purchase order. If Anthropic runs out of funding or finds cheaper compute elsewhere, that revenue vanishes in 90 days.
Still, the fact that they have the physical capacity to even offer that much compute shows the sheer scale of the Colossus project.
It really does.
But the Anthropic deal is just leasing hardware. The second massive AI reveal shows them aggressively moving to acquire the software layer. Let's talk about the cursor option.
This is one of the most fascinating corporate maneuvers in the entire filing.
It's crazy.
SpaceX struck a $10 billion collaboration deal with a company called Cursor. For those who aren't software engineers, Cursor makes an incredibly popular, wildly successful AI-native code editor.
Right.
It is used by developers all over the world to write, debug, and optimize software using artificial intelligence.
But it's not just a friendly collaboration. The S1 details that SpaceX secured a legal option to buy Cursor outright later this year.
Yes.
The pre-negotiated purchase price is $60 billion. That alone is a massive acquisition target. But the structure of the option is what is truly insane.
A break fee.
Right. If SpaceX decides, for whatever reason, to walk away and not execute the buyout, they still have to pay Cursor a $10 billion penalty break fee.
That legal structure is almost unheard of in modern mergers and acquisitions. It sets an absolute ironclad valuation floor for Cursor, and it shows the market just how aggressively SpaceX is moving to acquire key monopolistic pieces of the global AI software stack.
Let me ground this in another real-world analogy.
Okay, let's hear it.
It is like you are shopping for real estate and you decide you want to buy a luxury estate that is listed for $60 million. You tell the owner to take it off the market and put it on layaway for you.
Right.
But to get them to agree, you sign a legally binding contract saying that if you change your mind and decide you don't actually want the house, you will still hand the seller $10 million in cold, hard cash just for wasting their time.
Wow, yeah.
That is an absurd, almost reckless level of aggressive spending. It practically forces SpaceX's hand. They either spend $60 billion to buy the company, or they literally set $10 billion on fire for absolutely nothing in return.
It is intensely aggressive.
Yeah.
But it speaks volumes about the internal belief of Elon Musk and his executive team.
What do you mean?
They clearly believe that integrating an industry-leading AI code editor directly into their broader ecosystem, pairing Cursor's interface with the Grok language models and powering it all with the Colossus data center compute will create an inescapable developer monopoly.
I see.
They believe owning the primary tool that engineers use to build the future of software justifies that massive, risky premium.
So let's look at the board so far. We have Starship burning billions of dollars in Texas to build the largest rockets in history. We have Colossus burning billions of dollars in Memphis to build the largest artificial brains in history.
Two very expensive projects.
These seem like two entirely separate, incredibly expensive endeavors. But the S1 brings these two cash incinerators together in a unified vision that sounds like it was pulled straight from a sci-fi movie.
It really does.
We have to spend some time exploring the orbital data center vision.
This is the section of the S1 where the long-term, multi-decade roadmap suddenly snaps into crystal clear focus.
What's the plan? SpaceX doesn't just want to build massive AI data centers on Earth. They explicitly, formally state in the filing that their ultimate goal is to put AI compute infrastructure directly into space.
Stop right there. Why?
It sounds crazy.
Why would anyone willingly go through the astronomical expense, the logistical nightmare, and the severe physical difficulty of launching incredibly heavy, sensitive computer servers into low Earth orbit? What is the practical business reason for doing this?
It all comes down to the severe, potentially insurmountable physical constraints we are currently facing on Earth.
Constraints like what? Terrestrial AI data centers, the buildings housing tens of thousands of NVIDIA GPUs, face two massive intersecting bottlenecks. First, they require vast, almost unfathomable amounts of electricity.
Right.
Second, because they use so much power, they generate enormous amounts of heat. That heat requires massive amounts of water and cooling infrastructure to dissipate. It is becoming a severe global infrastructure crisis.
Right. We are seeing reports of entire major metropolitan cities warning that they are running out of power grid capacity because AI data centers are sucking up all the local electricity.
Exactly. The power grids on Earth simply cannot scale fast enough to meet the exponential demand of AI training.
But space fixes that.
Yes. If you move the data center into space, those earthly constraints completely disappear. If you place a server farm in a sun-synchronous orbit, it has access to continuous, unfiltered, virtually unlimited solar power.
Wow.
You are harvesting energy directly from the sun with no atmosphere in the way, and you are no longer tethered to a struggling terrestrial power grid.
Okay, that solves the power issue. But what about the heat? You have servers running at max capacity, generating immense thermal loads. How do you cool a supercomputer when you don't have access to millions of gallons of lake water?
Space is a freezing vacuum.
Oh, right.
While you have to carefully manage the heat generated by the sun on the exposed side, the dark side of the satellite is exposed to the absolute zero temperatures of deep space.
That's incredibly cold.
Through advanced radiative cooling technology, essentially radiating the heat away from the servers and directly out into the infinite void of space, you solve the massive thermal management problems that plague Earth-based centers.
So let me make sure I have this straight. The ultimate vision is to use the massive lift capacity of the Starship rocket to launch thousands of tons of heavy server racks into orbit. Once up there, they deploy massive solar arrays to power the GPUs with the sun. They use the freezing vacuum of space as a natural air conditioner. And then they use the existing Starlink laser communication network to beam the results of that massive AI processing power back down to users on Earth at the speed of light.
That is the thesis.
Yeah.
Now, we have to be realistic here. It is an incredibly difficult, monumental technical challenge.
I would assume so.
The S1 itself admits that no one has ever successfully done this at scale. The cosmic radiation in space can cause bit flips in processors, the launch vibrations could destroy delicate hardware, and building it will require thousands of dedicated Starship launches.
So it's a huge risk.
But if they can actually pull it off over the next decade, it completely bypasses the terrestrial energy grid. It would give SpaceX an absolute unassailable monopoly on the most power-efficient, infinitely scalable AI compute infrastructure in the solar system.
It is a breathtaking vision, but it brings us to a harsh financial reality check.
Yeah, let's look at the numbers again.
We have an aerospace conglomerate generating $18.7 billion in revenue, kept afloat entirely by a highly profitable satellite internet business, but incinerating nearly $5 billion a year to build Mars rockets, earthly supercomputers, and speculative orbital AI data centers.
Right.
How do we make sense of a company with those financials being valued by the public market at $1.77 trillion? Are investors rationally buying the future cash flows, or are they just blindly buying retail hype?
That is the central raging debate on Wall Street right now. To truly understand the deep skepticism from traditional financial institutions, we have to look at the valuation multiples.
Let's do that.
At the IPO price of $135 a share, the market is effectively valuing SpaceX at roughly 94 times its 2025 revenue.
Let's explain that for the listener who might not stare at Bloomberg terminals all day. What does a 94x revenue multiple actually mean in practical, everyday terms?
A revenue multiple is a shorthand mathematical way that investors compare how expensive a stock is relative to how much money the business actually brings in through the door.
Okay, give us an example.
For example, a normal, highly profitable, deeply established tech giant, think of an Apple or an Alphabet, might trade at a multiple of maybe 6, 7, or 8 times its annual revenue.
Okay, 6 to 8 times.
Even NVIDIA, at the absolute euphoric peak of the AI hardware boom, when they were generating massive, record-breaking net profits every quarter, traded at less than half the multiple that SpaceX is currently commanding.
So investors buying SPCX at $135 a share are willingly paying $94 for every $1 of revenue the company generated last year.
Yes.
And we have to remember that $1 of revenue didn't even result in a profit. It resulted in a massive net loss.
That's the piece most people miss. To mathematically justify a $1.77 trillion price tag using a standard, even highly aggressive tech industry multiple, SpaceX would need to be generating somewhere between $150 billion and $175 billion in revenue today.
Not the $18.7 billion they actually reported.
Exactly.
So the traditional financial math, the discounted cash flow models, they just don't add up based on the current physical reality of the business.
Which is exactly why we are seeing a major, highly public split in the financial world. We have dueling analysts, highly credentialed experts, looking at the exact same S1 document and arriving at vastly different conclusions about what the company is actually worth.
Let's look at the bear case first. Morningstar, one of the most respected independent research firms, published their analysis.
Right.
Their lead analyst, Nicholas Owens, dug deep into the financials, ran the models, and valued SpaceX at just $780 billion. That is literally less than half of the IPO price.
Right. Morningstar is looking at the harsh realities. They see the unproven, highly speculative profitability of the AI segment.
And the tiny float.
Yes. They see the tiny 4% public float that is mechanically, artificially inflating retail demand. They see the massive multi-billion-dollar capital expenditure requirements looming on the horizon for Starship and Colossus.
So what's their conclusion?
And they are concluding that the $1.77 trillion price tag is largely a mirage, driven by index mechanics and retail euphoria rather than sustainable business fundamentals. They are actively advising their clients to wait until the lockup periods expire and the stock price settles back to earth before buying.
But then you have the bull case. You have 𝗏𝗏𝗏𝗏, the famous dean of valuation from NYU Stern. He is widely considered one of the foremost experts on corporate valuation.
Yes, he is.
And he actually raised his price target after reading the S1. Before the document was released, based on private market estimates, he valued them around $1.21 trillion. After reading the disclosures, he bumped his valuation up to the $1.25 to $1.3 trillion range.
𝗏𝗏𝗏𝗏's analysis is fascinating. He looked past the AI hype and focused on the confirmed 67% gross margins in the space segment, and he modeled out massive long-term revenue targets for the integration of AI into the global satellite network.
But he still had reservations, right?
He did. He also acknowledged the reality of the cash burn. He significantly slashed his AI profit margin assumptions because of the immense physical delivery costs and the fierce competition from companies like OpenAI and Google.
So his takeaway was a bit mixed.
His ultimate takeaway was nuanced. The total addressable market became much bigger, but the execution risk became far more volatile.
And crucially, even 𝗬𝗎𝗫 highly optimistic best-case scenario valuation of $1.3 trillion is still almost $500 billion below the actual IPO price. So literally no credentialed independent financial analyst is saying this company is fundamentally worth $1.77 trillion today.
No one relying on traditional math is making that claim.
But there's another massive layer of risk here that goes entirely beyond revenue multiples and gross margins. It's a structural risk buried deep in the corporate governance section of the S1. We have to talk about the Elon factor.
This is perhaps the most critical piece of the document for long-term investors. The S1 details a highly aggressive dual-class share structure.
How does that work?
The Class A shares, which are the shares sold to the public on the NASDAQ, get 1 voting right per share. The Class B shares get 10 voting rights per share.
And who holds the Class B shares?
Almost entirely Elon Musk. And as a direct result of that structure, the filing confirms that he personally holds roughly 85% of the total voting power of the entire conglomerate.
85%.
Yes. That means the public investors buying those 555 million shares have literally no say in how the company is run.
They can't vote down a bad decision.
No, they cannot vote down a bad acquisition. Musk can unilaterally approve corporate mergers, executive compensation packages, and massive strategic pivots without needing a single vote of approval from the public shareholders.
Wow.
Because of this, the company is officially classified by the SEC as a controlled company, which legally exempts them from standard corporate governance rules, like having independent directors on their compensation and nominating committees.
Okay, I hear that, but I have to play devil's advocate for a minute.
Go.
Controlled companies are not entirely unique in the tech sector. Mark Zuckerberg has a similar iron grip voting control at Meta, and founders often demand voting control to protect their long-term vision from short-term Wall Street pressure.
True.
But the S1 reveals something else that makes this 85% control much more concerning than a standard tech founder structure. Let's look at the related party transactions section.
This part is wild.
This is the part of the disclosure where the company has to admit when it spends corporate money with other entities connected to the board of directors or the CEO.
The related party section of this S1 is unprecedented. It runs for 9 dense pages. The commingling of funds and assets across the Musk empire is extensive.
Let's give the listener some concrete examples from the sources. Where is the money actually flowing?
Let's start with the board of directors. Antonio Gracias sits on the SpaceX board and runs a private investment firm called Valor Equity Partners. The S1 reveals that various xAI subsidiaries signed 3 separate massive equipment lease agreements with Valor. The total aggregate cash payments for these leases amount to over $20 billion.
$20 billion.
And here is the kicker. SpaceX itself is the ultimate financial guarantor on all those leases.
So the publicly traded SpaceX is guaranteeing $20 billion in payments to a private financial firm run by its own board member.
Exactly.
I am looking at this from a traditional investor's perspective, and I am terrified. A $20 billion guarantee to a board member's firm is a massive conflict of interest. What else is in there?
Then there's the relationship with Tesla, the publicly traded automaker, which Musk also runs as CEO. The S1 shows that the xAI segment bought over $500 million in computing goods and services directly from Tesla in 2025 alone.
Wow.
The SpaceX segment bought another $144 million from Tesla. The 2 companies are also collaborating on a joint, highly expensive custom chip manufacturing project called Terafab.
Is that it?
Oh, there's more. Furthermore, there are disclosures about SpaceX leasing office space from the Boring Company, which is another private infrastructure company owned by Musk. There are details about xAI leasing property from a mysterious holding entity called Musk Industries, LLC. And there are logs showing SpaceX-owned corporate aircraft being routinely used for Tesla business travel.
So when you log into your brokerage account and buy shares of STCX, you are not really buying into a standard, cleanly delineated corporation with traditional checks, balances, and a rigid firewall between personal and corporate interests.
Not at all.
You are essentially just handing your wallet to Elon Musk and funding a sprawling, multiplanetary conglomerate where he holds 85% of the votes and casually moves hundreds of millions or even billions of dollars between his various other companies. Is the broader market actually pricing in that level of governance risk?
It is the ultimate question for asset managers. To their credit, SpaceX is transparent about the danger. In the S1 risk factors, they explicitly name Elon Musk as a key man risk.
They admit it.
They openly admit that his divided attention across SpaceX, Tesla, xAI, The Boring Company, and Neuralink could create severe operational conflicts of interest. They even note that, unlike many corporations heavily reliant on a founder, they do not carry key person life insurance on them.
But if the financials don't justify the price, and the corporate governance is a maze of related party transactions and absolute dictatorial control, why are sophisticated investors willing to accept all this? Why pay $1.77 trillion for a loss-making entity where you have zero voting power and the CEO is routing corporate funds to his other projects?
Because of a powerful overarching narrative circulating on Wall Street known as the amalgamation trade.
Let's unpack this theory. What exactly is the amalgamation trade?
It is a persistent structural rumor which major crypto and financial research desks like BitMEX explicitly highlighted in their IPO guides that Musk's ultimate decade-long endgame is to eventually merge SpaceX, Tesla, xAI, Neuralink, and X into one single, unified, monopolistic mega-holding company, a true Musk Corp.
It sounds like the modern equivalent of a Japanese Keiretsu, or a futuristic version of Berkshire Hathaway, where all these disparate frontier technologies exist under one massive corporate umbrella.
Exactly. The amalgamation theory posits that if you buy SpaceX stock today, you aren't really buying the 2025 cash flow of the Starlink network. You're buying an early golden ticket to a speculative 2030 future.
A ticket to the future.
Yes. A future where this single entity controls the global satellite internet backbone, the dominant artificial general intelligence model, orbital data centers, fully autonomous physical robotics via Tesla, and the only transportation system capable of reaching Mars.
Wow.
Investors are willingly paying a massive, seemingly irrational premium because they are betting on the ultimate consolidation of all these monopolistic technologies.
So they aren't buying the math of 2025. They are buying the mythology of 2030. They are buying the story.
They are buying the story, and they believe the story is inevitable.
But the reality is, the launch of a $2 trillion asset into the public markets based on a story doesn't happen in a vacuum. It creates immense gravity.
It creates a massive crater.
It creates collateral damage and massive ripple effects across the entire global financial system. We need to look at the shockwaves this IPO sent through the markets. Let's start with what analysts are calling the space sector slaughter.
It was an absolutely brutal day for any publicly traded space company not named SpaceX.
What happened?
The moment SPCX began trading on the NASDAQ, capital immediately violently drained out of every competitor in the sector. Virgin Galactic, the space tourism company that has struggled for years, saw its stock plummet by a catastrophic 34% on IPO day alone.
34% in one day.
Satellite imaging firms like Planet Labs dropped 9%. Communications companies like EchoStar dropped 11%.
Why did they all tank simultaneously just because SpaceX went public? It's not like Virgin Galactic's underlying business changed overnight.
It's all about liquidity vacuums and capital allocation. Before June 12th, if a mutual fund manager or an institutional investor wanted exposure to the emerging space economy, they had no pure-play apex asset to buy.
So they bought a little bit of everything.
Right. They had to spread their capital across a basket of these smaller, riskier, niche, publicly traded space companies. But the moment SpaceX listed, it instantly became the ultimate, highly liquid, dominant apex predator of the entire aerospace sector.
So they just sold the others?
Investors immediately sold their shares in the smaller, riskier companies and rotated all that capital directly into SpaceX. Why take a risk buying a new satellite operator when you can simply own the monopoly responsible for launching 80% of all mass into orbit?
It's the gravity well effect. SpaceX is so massive and the narrative is so compelling that it just sucked all the available investment capital out of the room, leaving the competitors starving. But here is the most fascinating part about the demand for this stock. It's not just retail investors and active mutual fund managers choosing to buy it. A huge multi-billion-dollar portion of the demand is entirely unofficial, mechanical, and forced.
The fast entry rule.
Yes. Let's talk about NASDAQ 100 forced buying, because this is where the financial engineering gets truly devious.
This is a crucial, deeply structural point about modern market mechanics. Typically, a newly public company has to wait a significant amount of time, usually years, and prove consistent, JAP-certified profitability before they are allowed to be added to major stock indices like the S&P 500 or the NASDAQ 100.
Right, you have to earn your way in.
But the NASDAQ exchange actually changed its own rules, creating a specific fast entry rule expressly to allow massive generation-defining listings like SpaceX to completely bypass those traditional wait times and profitability requirements.
So SpaceX gets fast-tracked. They get dropped directly into the NASDAQ 100 index in less than a month after their IPO. What does that actually mean for the stock price on a physical level?
It means that every single passive index fund, every exchange-traded fund, and every retirement account in the world that tracks the NASDAQ 100 will be mechanically, legally forced to buy SPCX stock.
They have to buy it.
They do not have a choice. It doesn't matter if the portfolio managers at Vanguard or BlackRock think the stock is wildly overvalued at $1.77 trillion.
Wow.
It doesn't matter if they read the S1 and saw the company is losing $5 billion a year. The mathematical rules of passive index investing dictate that they must aggressively accumulate the stock to match its massive weighting within the index.
So if you have a 401k that buys a tech index, your money is automatically buying SpaceX shares, regardless of the price.
Yes. And because SpaceX's market cap is so massive, those index funds will have to sell billions of dollars of other tech stocks like Apple, Microsoft, or NVIDIA just to free up the cash required to buy their mandatory allocation of SpaceX.
The domino effect.
This creates a massive, unyielding artificial floor of mechanical demand that supports the high valuation regardless of the company's fundamental financial performance.
Wow. When you put all those pieces together, the strategy is breathtaking. They intentionally engineered a microscopic 4% float.
Yeah.
They pumped that tiny supply directly to a rabid retail audience to ensure a day-one price explosion. And then they used the exchange's own fast entry rules to force trillions of dollars of passive algorithmic retirement money to step in and buy the stock at the absolute top, permanently locking in that $2 trillion valuation.
It's crazy.
That is an absolute masterclass in capital markets manipulation.
It is brilliant, ruthless, and perfectly executed financial engineering.
We have covered so much ground, but there is one last shockwave we absolutely must cover. I saved this surprising nugget for last because it completely blindsided the financial press.
I know exactly what you're talking about.
Buried deep within the balance sheet disclosures, past the rocket R&D and the AI servers, was a massive asset reveal that sent the cryptocurrency markets into an absolute frenzy. Let's talk about the $1.5 billion Bitcoin reveal.
This was a genuine shock to both traditional Wall Street analysts and the crypto ecosystem.
What did they find?
Prior to the release of the S1, on-chain analysts and crypto tracking firms estimated that SpaceX held roughly 8,200 Bitcoin on their balance sheet, based on breadcrumbs and old financial leaks. But the official audited SEC filing revealed they actually hold a staggering 18,712 Bitcoin.
Which at current market prices is worth roughly $1.5 billion US.
Yes. The filing details that they acquired this massive reserve at an average cost basis of around $35,000 per coin, meaning they are currently sitting on nearly $800 million in pure, unrealized profit.
That's a huge return.
This disclosure officially makes SpaceX the fourth largest corporate holder of Bitcoin in the world, instantly leapfrogging massive entities like Tesla and the Coinbase exchange.
But the immediate question from a traditional investor is, why? Why would an aerospace manufacturer, a company focused on building orbital data centers and Mars transport vehicles, choose to hold $1.5 billion in a highly volatile, decentralized digital currency instead of holding treasury bonds or cash?
It is an intentional, deeply strategic alignment of narratives.
Okay.
By tying a massive portion of its corporate balance sheet directly to 18,712 Bitcoin, SpaceX is intentionally bridging the gap between physical, cutting-edge space infrastructure and decentralized, censorship-resistant digital money.
I see.
When public market investors buy into the SPCX IPO, they're getting direct macro-level exposure to rocket manufacturing, frontier AI, a global satellite internet monopoly, and a multi-billion-dollar Bitcoin reserve. It permanently intertwines the success of the world's largest aerospace ecosystem with the success of the crypto market.
Elon Musk has essentially built a dual-engine corporate vehicle. It is powered physically by Raptor engines and financially by hard digital money.
Exactly.
And we saw the ripple effects of this integration immediately upon the filing's release. Major global crypto exchanges, platforms like Binance and Bybit, saw massive surges in deposits for SpaceX tokenized stock, which are synthetic, pre-IPO exposure products that trade on the blockchain.
Right. The crypto community saw the balance sheet reveal as ultimate institutional validation.
Exactly. It creates a powerful, self-sustaining feedback loop. Crypto liquidity flows into the synthetic SpaceX markets because of the ideological alignment. And SpaceX's corporate validation of Bitcoin strengthens the long-term institutional thesis for the digital asset class. It is the amalgamation trade, extending beyond traditional tech and into decentralized finance.
We have truly covered an immense amount of ground today, peeling back the layers of the most anticipated corporate disclosure of the decade. Let's take a moment to summarize the journey we've just taken, because the scope of what this company is attempting is almost difficult to hold in your head all at once.
That's a lot to process.
SpaceX just pulled off the biggest initial public offering in human history, raising $75 billion and hitting a $2.1 trillion valuation on its very first day of trading.
But the S1 revealed that they didn't achieve this as a simple rocket company. Through highly aggressive, complex common control accounting, Elon Musk transformed the entity on paper into a three-headed giant of launch vehicles, global telecommunications, and frontier artificial intelligence.
The three roommates.
Exactly. We learned that while the Starlink satellite segment is an absolute golden goose, printing billions in operating profit and effectively monopolizing maritime and rural connectivity, the overall consolidated company is bleeding nearly $5 billion a year.
Yes, the cash burn is real.
That massive record-breaking $1.77 trillion valuation relies almost entirely on executing massive, unproven, highly speculative bets. They must get the massive Starship vehicle fully operational to launch the next generation of satellites. They must execute on a $45 billion compute provision deal with Anthropic,
Which they can cancel in 90 days.
Right. They must navigate a $10 billion break fee to potentially buy the AI coding platform Cursor. And ultimately, they must figure out how to put gigawatt-scale AI data centers into the freezing vacuum of orbit.
And all the while, they engineered the entire public offering with a microscopic 4% float, a 30% retail allocation, and forced NASDAQ 100 index inclusion to ensure the stock price would explode upward on day one, completely detached from those multi-billion-dollar operational losses.
It is, without a doubt, the most complex, ambitious, and aggressively structured corporate offering we have ever analyzed. It challenges every traditional metric of financial valuation.
It really does.
And to our listeners, I want to remind you why we do these deep dives. By understanding the actual physical and financial mechanics buried deep in the footnotes of the S1, you're now seeing right past the day one retail hype.
You're seeing the truth.
You aren't just looking at the spectacular rocket launch on the news, you are looking directly into the engine room. You understand the true structural risks, the accounting magic of merging three massive companies, the terrifying 94x revenue multiple, the blatant conflicts of interest in the related party transactions, and the revolutionary multiplanetary ambitions driving it all under the hood. You are now equipped to watch how this historic stock trades over the next year with a critical, deeply informed eye.
That is the ultimate goal. Knowledge is only truly valuable when it's understood and applied to reality. And understanding the intricate underlying mechanics of this specific deal is absolutely crucial for anyone participating in, or even just observing, the modern capital markets.
Absolutely. But before we wrap up, we always like to leave you with a final lingering thought, something that builds on everything we've unpacked today, but challenges you to look even further out onto the horizon.
We spent a significant amount of time today talking about the governance structure, specifically the 85% voting control that Elon Musk retains over this new public entity. If we connect this absolute dictatorial control to the bigger picture, consider what SpaceX is actually physically building. They are building the definitive infrastructure for global human communication with the Starlink network. They are building the intelligence layer of the future with Grok, the 𝗥𝗲𝗃𝗲𝗃, and potentially Cursor. And they are building the sole means of off-planet transport and interplanetary logistics with Starship.
So here's the question we want you to mull over as you watch this story unfold.
What is it?
What are the long-term existential implications for humanity when the essential foundational infrastructure for our species' future, the way we communicate, the way we process intelligence, and the way we eventually leave the Earth, is publicly traded, funded by our own passive retirement accounts, but entirely controlled by the unchecked, unfirewalled, absolute voting power of a single human being?
It raises profound, perhaps unanswerable questions about the future of corporate governance, the power of technological monopolies, and who ultimately controls the infrastructure of human destiny.
It is a landscape that is, as we noted at the very beginning of the show, incredibly murky and completely uncharted. We have officially traded the clean, predictable columns and rows of traditional corporate accounting for a complex, volatile, multiplanetary financial ecosystem. And we are all, whether we hold the stock or not, just strapping in for the ride. Thanks for joining us on the deep dive. We will see you next time.